All right, the trading day has begun, and while in Toronto we've seen some weakness for the energy stocks this morning, there still seems to be some broader momentum for equities overall. And I was saying earlier, the S&P is putting together what could end up being one of its best Novembers ever. Certainly one of the best monthly performances from the U.S. benchmark since last summer. And the TSX, even with this flat performance today, on track for what would be the second best month of 2023. David Burrows is president and chief investment strategist at Barometer Capital Management, and he joins us here in studio. Talk more about the stock market story. Broadly speaking, are you surprised that November has been a positive one?
No, really, look, we went through a cyclical bear market into the October lows of 2022, about 24%. Typical cyclical bear market. We've been making higher lows since then. We had a typical 10% seasonal sell-off into the end of October, at which point people were really underinvested and super bearish, and we had a great thrust off the bottom. So came right at the exact time from a seasonal perspective you'd expect. We had a signal that happens very rarely, a big bread thrust, 9 out of 10 days, very significant advancers over decliners, which typically happens at cyclical lows. And we're sort of moving forward, I think, into the next 4-year business cycle.
And in terms of the kinds of sectors that benefit from that, I mean, you've talked pretty consistently about names in the Canadian market that would benefit from that. You're sticking with that.
Yeah, I mean, we believe that our job is to identify areas that have a structural tailwind. And longer term, we think that there are some very important themes in this market. One of them is reshoring of manufacturing to North America and the infrastructure build, and that requires a lot of stuff. So, I mean, the reality is we're all talking about AI and the impact that that has and the companies that benefit. That's an important theme, and we're there.
Yeah.
But we also think the areas that are underinvested are areas that will benefit from those other two themes, and those are industrials, those are materials companies, and so on.
And how does oil fit into the picture? It's been such a volatile period, and now I think we're looking at the stocks in the group in, on average, the red for the month. This is quite a hit for oil today. I think this, just to remind our audience, the latest piece is that we were anticipating a big conversation among OPEC Plus members. They seem to have some misalignment on production plans going forward. But oil has been struggling.
We think that that's kind of a near-term thing, right? I mean, we're right at a seasonal low typically for oil. There are lots of people still want to bet on a recession in the U.S. and a slowdown in demand. But the fact is, we still are in a situation where, you got to make sure we got supply lines in North American energy. I think is quite attractive.
Okay, you came with some top picks today, including a company in the energy sector in Imperial Oil. I mean, what is it about the makeup of the business that gets your attention?
So let's just be clear. I'm looking for characteristics in the companies we're investing in. So we've talked about CNQ, we've talked about others. I'll talk about Imperial. Both CNQ and Imperial Oil have very significant dividends and very significant cash flow. So we think maybe there's room down to $70 in oil, but there's a lot of upside over the next couple of years in oil prices that we think will continue to generate a lot of cash. Imperial has some great long life assets like a CNQ. It's got some good downstream assets, but ultimately it's the cash generation I care about. And if you can get a 5% yield that's going to grow sort of around 10%, I think that's a pretty attractive characteristic for investors.
Now, we are on the doorstep of Canadian bank earnings. JPMorgan in the U.S. is one of those larger financial institutions which you've mentioned in the past. What are the characteristics you're looking for in a bank investment right now?
Well, sadly, the big get bigger, right? And so JPMorgan continues to be the 800-pound gorilla. I have to be honest, we have no Canadian bank exposure and haven't had for some time. The fact is, probably the Canadian economy has a little bit more downside, and especially more exposure to the real estate market, which we think is likely to be soggy for some time. And so mortgage origination is difficult. Still, deposit growth is not here in the Canadian marketplace. A lot of money moving to money market, and we think that the margins are just going to be tough for a while.
So we've got Canadian bank earnings coming up next week. Do you have Do you have concerns about what the banks will say in those results?
I just think we only need 20 to 30 companies to build a portfolio. We don't need companies with major headwinds in the near term. So that can change. They're great businesses long term, but in the near term, they definitely have some headwinds. And I think that there's other things to do.
I saw another name on your list there, Visa, which has a few different components. I mean, I guess we could ask, what's the health of the consumer and what does that mean for a business like theirs? Sometimes I guess we think of them as a player with strong ties to the financial community, but then you've got other people that say that is a technology company.
Right,
so
right.
How does it fit into your portfolio of give or take 20 names?
Well, again, you know, the big are getting bigger, and they are right in the center of all the transactions that happen globally. One of the things about Visa that's important to remember is that their sales are growing at like mid-teens, and their margins have steadily been expanding, so their earnings are growing closer to 20. 56% of the revenue is international, and that's higher margin business. And if you look at the surveys, consumers' plan to do international travel is way above norm over the next 12 months. So we think that their international business can continue to fuel earnings, and they'll beat expectations. And again, it's a dividend growth stock. It's only a 1% yield, but it's growing the dividend at like 15% a year. We think that that's the kind of characteristic that investors are going to want to see in this world.
And real quickly, there are companies out there that would be at risk of not growing their dividend in this kind of environment?
I think that there's lots of companies that have high dividends, that have no dividend growth, and we have seen consistently, while rates were ratcheting higher, and since rates have actually pulled back a bit, dividend growth stocks are outperforming high dividend growth payers, and we think that you want the combination of two for total return.
Okay, David, good to see you. Appreciate the time as always.
Thanks for having me.
David Burrows is President and Chief Investment Strategist at Barometer Capital Management. Time for a quick break. There is quite the drama playing out in Silicon Valley. Sam Altman of the AI startup OpenAI, after being ousted from the company just a few days ago, is back at the helm. We'll talk about what happened next. Okay, here we go, David. 3, 2, 1.
So,
sorry, I'll.
Sorry.
Okay, here we go.
Sorry.
David Burrows, if you had to pick one stock right now, what would it be?
I think that we want to make sure we're participating in big themes, and the big are getting bigger. Visa is right in the center of the move to digital payments. That's not slowing down. They're growing at 15%. Their margins are expanding. Their earnings are growing closer to 20%. And that means that they'll be able to grow their cash flow. And we think companies that are generating lots of cash are far more attractive in a higher rate world. They've been able to grow their dividend about 15% a year. And so if you can get some nice cash flow growth, dividend growth in a predictable world, that's attractive. The kicker is that consumers continue to look toward international travel, and their margins expand on their international business. About 56% of their business is international. And so we think that that can fuel above average earnings growth over the next 2 years.